Good evening and season's greetings to you all. Let us speak about the Indian equity markets. This last month did not provide any respite, and the markets continue their downward trend for the first, for the entire month of November, before recovering a little bit in the month of December, which was the first fortnight in quite some time in which we saw some positive response from the market. Now, as you know, the global markets have been going through a period of turmoil, and what we have noticed is on the back of the US consumption slowing down, there has been the production related downturn also in the Chinese markets. So, on the back of consumption slowing down in the US and China's production also slowing down on the back of it, there has been a huge impact in the world markets. Now, we have seen the various central bankers trying to rescue the economies of their various countries, and there has been a sustained long-term impact and a long-term plan which has been rolled out on this front. We've seen the US Fed continuously cutting rates. This cue has been taken by the ECB as well as the Bank of the UK. There have been substantial financial packages announced wherein, apart from the cut of interest rates, which has been happening almost globally right now, there has been financial bailout packages which has been announced by the US as well as other major European countries. The recent case to the point being the 306 billion bailout by the US Fed for Citigroup. Coming back to India, we have finally reversed our downward trend, as I said, in the first fortnight of December. Now, the BSE mid cap, the BSE small cap, as well as the Sensex and the Nifty, they showed up positive numbers. This has been on the back of sustained efforts from the government as well as the RBI. The RBI has cut the repo rate and the reverse repo rate quite significantly. Currently, the reverse repo rate stands at 6.5% and the repo rate stands at 5%. We have also seen that there have been around spending of 200 billion this fiscal year, and there have been SOPs which have been announced for SMEs, for infrastructure oriented companies. With this, we believe that the central bank has sent out a strong signal that we are not going to compromise on growth. And as the inflation seems to be pretty much in control, with the current numbers showing up in less of 8% currently, we expect a sustained policy from the RBI to be developed in order to maintain industrial growth. Now, as I speak of industrial growth, the IIP has actually shown a negative trend for the first time in the last 15 years, wherein the IIP index went down by 0.4% for this particular quarter year on year. Inflation is currently under check, and it came on the back of 8%. If we are to speak about the foreign currencies, the Indian currency has appreciated against the dollar, but the impact is short-lived over here because we've depreciated vis-a-vis the euro. So actually, the appreciation in the Indian rupee has been on the back of a depreciating US dollar and not on the strength of our economy. If we are to speak about crude oil prices and commodity prices, now they have been going down significantly over the last 3 to 4 quarters. And we currently look at the crude oil prices in the range of $37, $38 per barrel, which is a far cry from the $140 per barrel, which we saw less than a year ago. If we are to look forward to it, we expect the crude oil prices to go up. There are certain analysts who are commenting that within the next 12 months, crude oil could shoot up to as much as $75 a barrel, and within 24 months, it can shoot up to more than $100 a barrel. But it seems that around $50 to $60 per barrel range over the next 12 months is something which can be thought of as a good projection at this point of time. The Indian markets are currently trading at around 10 and a half times FY09, FY10, and these are good levels for investors to start buying into the market. So as usual, we would suggest people to split their investments and invest through a systematic investment plan or a systematic transfer plan, wherein small amounts of money can be allocated over a period of time. So you invest small amounts of money every month, which will help you benefit from the volatilities of the market as it lies currently.